Hello trade pros, welcome to another video. Today we're going to be talking about how to buy the dip. And I'm going to share some really important tips with you on how to actually initiate this process, when it's time to buy the dip, and how you should be doing this following 4 easy steps to get you started on your journey. Before we begin, please remember to hit the like button and subscribe to our channel. We release great content every single day, and hit the notifications bell so you're alerted. So let's dive into this video and talk about 4 steps on how to buy the dip. So first, let's start out by, first of all, what is a dip, right? Dips could be different things and mean different things to different people. Stock markets move in repeatable cycles. If you look at any stock ticker or symbol, you'll notice that typically what stocks do is they'll have an impulse wave in bullish markets, which means the stock goes up, and then you'll see it peaking and pulling back, which is called the corrective phase. Correction is defined in the stock market as a 10% drop or more in the stock market or the stock that you're following. So the first thing you want to do is start to recognize these patterns and follow the stocks that you're interested in and look at the charts. Find the moments when the price is rallying up, identify the impulse wave, and then identify the correction phase of that wave. Write down the things you notice. When does it stop dropping? Where is the price level usually? What percentage on average does the stock drop before it turns around and start going back up? Every single stock is different, and if you're gonna buy the dip on any one of them, you really have to start by getting to know that stock. Think of it this way. Each stock, each company that you could invest in is a separate person. They're their own entity. So before you could invest in that person, you have to spend some time getting to know them. So build the relationship with that stock from the sense that you know how much it rallies, how much the average pullbacks are, and spend some time familiarizing yourself so you know what a dip really is for that specific stock. Also, keep in mind that there's market cycles in play here as well. When the market is extremely bullish, dips tend to be less of a pullback. Stocks drop less before they go up. When there's a little bit more chaos in the markets, like right now, like a war, like a Federal Reserve increasing interest rates, stock markets will dip more. They will usually lose more value before they start to recuperate and get back on the upswing. So that's my first tip for you in defining what a dip really is. Go out there and look at the charts of your favorite stocks and examine these characteristics. Write it down in a journal too. Get to know the stock that you're going to be investing your hard-earned money in. So now that we talked about what a dip is, I want to talk about the moment of actually buying into the dip. And then we're going to get into the 4-step process very briefly here. So when you're in the market and you have yourself an idea, you're saying, you know what, right now the prices are too rich. I'm going to wait for the price to drop before I buy it. All right, at that moment, because you're not really committed emotionally and with your money, you're patient, you're calm, you're focused. And then the stock starts to drop. And even though you planned for this to happen for you to get in, as the drop is happening, you start to get emotional. You start to get feelings, you start to get anxiety. You start to think, hey, I could lose money. And you start to lose your focus really and truly. Because even though you planned to buy when markets are going down, when they're actually going down, it feels completely different. It's an emotional process. And, there are people out there getting hurt and losing a lot of money while you're waiting to buy it. So because of that, typically it becomes extremely hard to actually buy the dip in theory and in practice when you're executing without a strategy. So the next 4 steps, I'm going to lay out a strategy for you that you could use to buy the dip in any stock. And we're going to start out with the very basics and work our way through it. Now, in reality, this could probably be a series of videos, but I'm going to do it here in this one video because I really believe we're in a cycle of the market right now where knowing how to buy the dip properly is going to be really useful knowledge in the near term. All right, so let's get started with 4 steps on how to buy the dip on the stock of your choice. All right, step number 1 for buying the dip. I can't tell you how important this is. This is the most important step, hands down. The thing you want to do here is to choose the right stocks. You have to understand that not every stock is something that you want to invest in. I know some of them are trending. I know some of them are sexy. You'll hear about them on Twitter, people who made a lot of money, some obscure names with some obscure letters and companies you've never heard of before. Buying the dip in those stocks is going to be risky because they don't have a historical pattern of how they move. They're volatile, they're all over the place because it's a company that is not yet established. So when you're buying the dip and investing your hard-earned money, make sure you're choosing stocks that are, billion-dollar companies that make products that you know of. You don't want to be learning about a company's management, their, manufacturing process, their viability. There's so many great companies of high value. And when you're buying the dip in those companies, you automatically have a higher chance of success because there are other people buying the dip as well. It isn't just you and a group of 20 friends that are trying to buy this obscure stock. It's literally the entire market. Every fund manager, every institution, you have pension funds, you have endowment funds, are going to be chasing the same stock. So buying the dip works better on high quality companies that make products you know about. Think about Apple, think about Microsoft, Google, Facebook. Those are the caliber of companies you should be considering. Small penny stocks and obscure company names shouldn't really be even considered for buying the dip because they haven't been established. They have a high failure rate and a high risk comes with it. So the first step is choose the right stock before you even consider buying the dip. And my tip here is buy companies that make products that you own and that you know of. If you start there, most dip buying opportunities will come with less risk. Step number 2, plan your entry before the moment comes where you have to get in. This is super important because, again, we go back to the example where you want to buy the stock. You're saying, once it gets down there, I'll buy it. And then it gets down there and you're afraid like everybody else, and then you miss that opportunity. So have a plan. Having a plan is critical, not when you need to use it, but before you even need it. All right. So the idea here is the stocks are trading on highs, everything is going up, and you're thinking to yourself, okay, how will I initiate this trade when it comes down? And when you get into this plan of where you're going to enter, this is the whole industry. The door is open to a whole different analysis framework that you could use. I personally prefer technical analysis. Some good things to get started and where you're going to identify a level of entry is a rule of thumb. Typically, stocks drop about 10%. We call that a correction. Those are good automatic buying opportunities, but don't just put your order at a 10% drop. Qualify it in real time. So here's what I mean. Start out by having an idea of where you think that stock is going to drop to. So if we're trading at all-time highs, look at the stock and say, where will it drop such that my money will be well invested? 10% is a good start. Other things you could use is a 50-day and a 100-day moving average. Those have traditionally and statistically been the backbones of a lot of great trading strategies. So as it gets down to a 50-day or 100-day moving average, it's an opportunity for you to start initiating your buy the dip strategy. I will tell you this, there's 2 ways to do this. Number 1 is just technical analysis, all right? And number 2 is getting trading signals. I'm just kidding. Never use trading signals, all right? I'm deathly allergic to signals. Number 1 is technical analysis. So when you find these levels from a technical standpoint, it's great because it's theory driven, but the reality is in practice, it's different. So this is where the tip came to help you research that stock. Because if a company like Apple is where you want to buy the dip, on average, Apple drops 4 to 5%, and it drops less than other companies. Another area that I really like to target as an entry level for buying the dip in stocks is a prior high. So let's say the trend is going up like this, and then it drops, comes back above that level. It will typically retest that prior high level where investors got emotional and FOMO'd in right at the top before it dropped. So the areas that I like to look for buying the dip is a combination of a 10% drop, moving averages between the 50-day and 10-day moving average, all right, as well as prior highs and prior lows in price structure. The best way to do this is to pull up a daily chart of your stock on TradingView. It's free, it's simple, and find the last prior high below the price that we're trading at the moment. Combination of those factors usually gives you a good idea. Now, an idea is a plan, but it's not the execution. Even though you have this idea, when the stock price gets to that level, you're still going to have to qualify it and ask yourself, when do I actually pull the trigger? Even though it's in the price level I waited for, when do I buy this stock? When do I put the money on the line? When do I buy this option, this future? It doesn't matter what you trade. Well, the answer to this is not simple. And the answer is at the same time incredibly simple. You buy it at multiple spots. One of my favorite ways to get into stocks on a dip moment is when it hits the level, what I'm watching for is the stock to stop dropping. So you'll see down movement every single day, and then one day, all of a sudden, it can't make a further low. When you see that candle start to form, it looks like either a doji pattern, and this is a term that you could look up. We've done a video on dojis as well. I like to see a doji or an engulfing candle or any bullish candle chart that indicates the selling has capitulated and now there's in fact more buyers coming in. Remember this, when stocks are dropping and it gets to a point where it's dropped so much, even people who have sold are now starting to think about getting long. So those are the points I like to identify in buying the dip. Is if we just summarize the step, because this is a long step. Step number 1, find a level and idea, know where you want to get in. Okay. Step number 2, when the price gets there, wait to see some kind of rejection candle pattern, whether it's a doji or a bullish engulfing pattern, something that shows you that the stock has stopped dropping. Because we like to buy things that are cheap on the way down, but we buy them too early. This is the analogy of catching the falling knife. How do you catch a falling knife from, let's say, a 30-story building? You're not going to sit there and be like, I'm going to get it. Because you're going to get your throat slit. What you're going to do is you're going to step out of the way, let it drop, and then pick it up. Now this dangerous knife is actually a tool. Same thing with the stock. Don't buy it on the way down. Allow it to bottom out first and see some upside momentum, and then start to buy weakness. That minute difference is the difference between professional traders and people who buy a dip and continue to buy even though the stock's getting annihilated. All right, so have an entry plan, and then when it gets there, start a small position and keep adding to it as long as we're not getting new lows. It's a very important point. All right, and now on to step 3. So you found your entry, you've planned the price, you're in the stock, and you've bought the dip. Step number 3 is, and this is a huge tip that I could give you, this is a lifesaver in many ways, is know where you're going to get out before you actually get in. So as part of your plan, identify where you're going to have a stop loss. If the stock drops below a certain threshold, then get out of it. Only risk 3 to 5% on any given buying the dip opportunity of your capital, because if you risk more, you may not have any for the next opportunity. I'm a big fan of trying a trade, and then if I'm wrong, getting out of it and cutting my loss, because then I have more capital to try it again the second time, rather than getting in and continuously putting more money into something that's not working, and I'm being proven wrong, and I keep buying, and I run out of all the capital. I get stopped out, my portfolio gets closed because I annihilate it, and then the market turns and starts going up. All right, it sounds frustrating, and it happens every day. So what you want to do instead is give yourself multiple opportunities. Know where you're going to get out. If this opportunity is great, how much are you going to risk on it? 3 to 5%. If you lose that 3 to 5%, rather than continuing to have hope and adding more and more money in a losing trade, take the L and start the plan all over again at a lower level. Start your analysis, find areas you're going to look at, and redo this whole process. It's always better to try a trade numerous times, even if you're losing them, rather than, turning a stock that's a friendship and trying to marry it, right? You never want to marry stocks and go to the grave with them, right? And I worked at Scotiabank, and I saw this every day with our clients. They would have to fill in a form to get rid of a dead stock. It was called defunct securities. And they would have to sign on the form, and I would ask them, hey, when'd you get the stock? They say, 7 years ago. I love this company, and I bought it, and I just watched it go down, and it's literally trading at nothing. It's zero. Basically, a defunct form means remove these securities from my account. They're worthless. The company's gone bankrupt. Don't be one of those people. There's no reason to hold something until it dies. All right? Use weakness as a buying opportunity, and if it continues to be weak, take the loss and re-enter and retry the trade at a lower price. You'll save more money, and because you're managing your capital, you'll have more money to buy it the next time to begin with. And when you do catch it, you'll erase your losses very quickly because you own it at a low cost base. So know where you're going to get out before you get in is a massive tip, and that's part of the planning phase. All right, and step number 4 is super easy. Execute the plan, right? Once you have a plan, once everything is put down on paper, you know what you're looking for, it's easy to pull the trigger because you've already planned it. If you're having a difficult time getting into trades, it's because you don't know what you're looking for. And if you don't know what you're looking for, anything could technically look good. And that's the problem in the market, is that in real time, we convince ourselves to take these low probability, high risk trades because we fill our convincers. Everything we know ourselves best, we could tell ourselves the things that are required to get into a position, and now we're committed, but that's not the way to do it. When you have a plan, you're stripping emotion out and you're being tactical about this. So it's super important, have a dip buying plan. In the market right now, it's down a lot. NASDAQ was down over 20%. It officially entered into a bear market. All right, so dip buying on the way down hasn't worked. It doesn't mean it won't. All right, so use this video to create a plan for yourself. And instead of just blindly buying things because you think that's what you should be doing, follow that plan. It removes emotion and turns you into a professional trader overnight. As long as you're doing what you're planning and planning what you're doing, there's an opportunity to improve and for you to turn this into a viable, sustainable career for yourself. So that's it. Now you're buying the dip like a professional trader. 4 steps. I gave you a lot of tips, a lot of value. I'd love to hear from you. What are some stocks you're looking to buy, and what are your levels and ideas of where to buy them? Pop it in the comment section. I'll help you review those trades and give you some feedback, and I'll help you really put this stuff into practice. If you guys are willing to have a discussion about it, comment section below right now, pop in the stock you're looking for and give us some levels and ideas, and we'll have a discussion about this. Because as much as you learn, trading is not a theory business, it's practice. So it's time for you to practice this material. One last tip I have for you is, if you haven't ever bought a dip, or you haven't been buying dips, or you're still confused and don't know how, go back and do a replay. All right, go and open a chart, go back in the past of any stock and practice finding the areas and moments that are high probability for you to get in. Practice will always give you the confidence in the future to make decisions with more confidence. You know, there's going to be an opportunity in the near future to start putting this information in practice. So I love you all. Thank you for tuning in. If you have any questions, pop them in the comment section below. Don't forget to hit the like button, subscribe to our channel, and hit the notifications bell for some great updates on a daily basis. If you want to learn how to use order flow and take your day trading to the next level, we have 2 great master classes, one on options and futures. I'll put the link in the description there as well. Thank you guys for tuning in. Have a great day. I'll see you at the next video. Manage that risk and trade like a trade pro. Oh, and lastly, the inflation video is coming out next week. It's a little bit delayed, but I'm going in deep, and we're doing this on a whole other level than I expected. So thank you for the patience. You're going to get a lot of value out of it. If you want to see the initial one I'm talking about, link is in the description as well. You guys have a great day. See you next time. Take care and goodbye.